Something is breaking beneath the surface of Britain's calm facade. The headlines speak of resilience, yet every indicator tells another story. A nation weighed down by debt, division, and decay. From struggling households to silent factories, from collapsing confidence to the fading power of the pound, the warning signs are no longer distant. Economists call it stagnation, historians call it decline, but for millions across the UK it feels like something far worse. The quiet unraveling of a system built on promises it can no longer keep. The question now isn't if collapse comes, but when. Number 1. Stagnant productivity growth. For over a decade, productivity in the United Kingdom has barely moved, creating one of the longest stagnations among advanced economies. This slow growth means workers are producing less value per hour compared to peers in countries like Germany or the United States. The reasons are complex: weak investment in modern machinery, declining innovation, and skills mismatches across industries. Many firms still rely on outdated technology and processes, while small and medium enterprises struggle to scale due to high borrowing costs and limited digital infrastructure. The result is a widening gap between potential output and actual economic performance, which directly affects national income and long-term living standards. Low productivity doesn't just slow wage growth, it also undermines the government's ability to fund public services. When each worker produces less, tax revenue falls behind the cost of welfare, healthcare, and infrastructure maintenance. The Office for National Statistics recently reported that output per hour remains below pre-pandemic levels, despite record employment. This imbalance forces policymakers to rely on borrowing rather than growth-driven revenue, creating fiscal pressure that weakens confidence among investors. Businesses facing low returns become hesitant to expand or hire, reinforcing a cycle of stagnation. The economy becomes trapped in a loop where poor productivity leads to low growth, which in turn prevents the investment needed to fix productivity. Experts from the Bank of England and the Institute for Fiscal Studies warn that productivity weakness is not just a statistic but a warning sign of deeper structural decay. When innovation slows, regions already struggling, such as the North East and Midlands, fall further behind the South, widening inequality. Over time, this fosters frustration among workers who see prices rising faster than their paychecks. Without substantial reforms in education, technology adoption, and regional development, the United Kingdom risks facing a generation where economic progress stalls completely. This slow erosion of efficiency, competitiveness, and optimism represents the quiet core of the UK's potential economic collapse in 2026. Number 2. High and persistent inflation. Over the past 2 years, inflation in the United Kingdom has proven far more stubborn than most forecasts predicted. Even after global energy prices eased, domestic costs for food, housing, and services have continued to rise sharply. The Bank of England has warned that underlying inflation remains deeply embedded across the economy, with wages and rents keeping upward pressure on prices. Households now face one of the highest costs of living in Western Europe, forcing millions to cut back on essentials. The persistence of inflation has eroded real incomes, weakened consumer confidence, and left many families struggling to maintain basic standards of living despite wage increases that appear strong on paper but fail to keep up with the price of essentials. This persistent price growth also places policymakers in a dangerous bind. To cool inflation, the Bank of England must maintain higher interest rates, yet each rate hike increases pressure on mortgage holders, small businesses, and public finances. The cost of government borrowing rises as bond yields climb, limiting the scope for fiscal stimulus or welfare expansion. Meanwhile, rising rents and utility bills create a feedback loop of hardship that filters through every sector. When workers demand higher pay to cope, companies raise prices to compensate, locking the economy in what economists call a wage price spiral. This dynamic has already triggered concerns among global investors who view the UK as a risky environment for long-term stability. Economists from major institutions such as Goldman Sachs and the London School of Economics note that persistent inflation reflects deep structural issues rather than temporary shocks. Supply bottlenecks, weak productivity, and post-Brexit trade barriers all feed into higher domestic prices. The country's dependency on imports for food and energy magnifies vulnerability whenever global conditions tighten. Unless inflation moderates soon, consumer spending, the main driver of the UK economy, will continue to fall, shrinking growth prospects through 2026. A nation where everyday goods feel increasingly unaffordable risks more than economic decline. It faces the erosion of public morale and financial resilience that can precede broader systemic collapse. Number 3. Unsustainable public debt and fiscal stress. The United Kingdom's public debt has surged to its highest share of GDP since the 1960s, and the strain is becoming visible across every layer of the economy. Years of borrowing to cushion shocks, from the pandemic to energy crises, have left the Treasury with limited room to maneuver. Debt servicing alone now consumes tens of billions of pounds annually, and much of it is indexed to inflation, meaning higher prices automatically raise government costs. As interest rates stay elevated, refinancing older debt becomes more expensive, amplifying fiscal vulnerability. Markets have already shown signs of unease, with bond yields climbing whenever investors sense hesitation in fiscal discipline. This cycle increases the cost of borrowing even further, deepening the sense that the UK may be approaching a breaking point in its financial credibility. At the same time, tax revenues have failed to keep pace with expenditure, as sluggish growth and weaker productivity reduce the income base. Public services, particularly healthcare, transport and housing, require massive investments to maintain functionality, yet every pound spent must now compete with rising interest payments. The government's latest budget projections hint at difficult choices ahead, either higher taxes on households already under pressure, or deep spending cuts that could harm growth prospects. The result is a tense balancing act where any external shock, such as an energy spike or geopolitical crisis, could tip the balance toward a fiscal crisis. Analysts from the Office for Budget Responsibility warn that even modest borrowing missteps could trigger market panic reminiscent of the 2022 gilt sell-off. This growing fiscal fragility undermines long-term stability. Investors demand higher returns to hold British debt, further straining public finances. Domestic confidence erodes as austerity measures loom, and political divisions widen over how to restore balance. Without meaningful reform in spending priorities and a credible plan to rebuild growth, the UK risks entering 2026 with a debt burden too heavy to sustain. The danger is not an immediate collapse, but a slow suffocation of economic flexibility, where each policy decision is constrained by obligations to past borrowing. This structural pressure forms one of the most immediate threats to national resilience. Number 4. Weak business confidence and investment. Across the United Kingdom, business sentiment has fallen to its lowest level in over a decade, signaling deep uncertainty about the country's economic direction. Recent surveys from the British Chambers of Commerce and the Confederation of British Industry reveal that many firms are postponing expansion, hiring, and innovation plans due to unpredictable policies and fragile demand. Rising energy costs, labor shortages, and regulatory instability have left even established companies hesitant to reinvest profits. Smaller firms, once considered the backbone of the UK economy, face tighter credit conditions and declining consumer spending, making survival rather than growth their primary goal. This environment of hesitation has created an investment drought that threatens to erode competitiveness across sectors ranging from manufacturing to tech. A major driver of this confidence collapse is the erosion of long-term policy clarity. Frequent changes in tax rules, environmental targets, and trade regulations have discouraged foreign investors who once viewed Britain as a safe and dynamic market. Multinational firms now divert projects to more predictable environments within the European Union or North America. The delay in green infrastructure projects and supply chain disruptions have compounded these anxieties, leading to stalled construction and delayed factory upgrades. Without steady inflows of capital, productivity cannot recover, and the job market risks stagnation despite headline employment numbers. This uncertainty also weakens regional economies outside London, widening the gap between the capital and the rest of the country. Economists from the Financial Times and Bloomberg highlight that weak business confidence is not just a temporary slump, but a sign of structural fatigue. Innovation hubs that once drove growth are seeing declining venture funding, while manufacturing orders have fallen to multi-year lows. When entrepreneurs lose faith in future stability, the ripple effects reach every household through lower wages, fewer job opportunities, and slower technological progress. By 2026, if investment continues to fall, the UK could face a scenario where economic recovery becomes impossible without drastic intervention. Confidence, once lost, is hard to rebuild, and its absence casts a long shadow over national growth potential. Number 5. Household financial strain and low buffers. Across the country, millions of British households are facing unprecedented financial pressure, struggling to balance essentials like rent, food, and utilities. The combination of stagnant wages, high inflation, and rising interest rates has created the tightest squeeze on disposable income in decades. According to recent figures from the Office for National Statistics, household savings have dropped sharply while consumer debt continues to climb. Many families rely on credit cards or short-term loans to cover basic living costs, a pattern that signals deep vulnerability within the domestic economy. As living expenses outpace earnings, families cut discretionary spending, which in turn slows business revenue and weakens overall growth. This creates a dangerous feedback loop. Lower consumption reduces production, leading to job insecurity and further economic fragility. The housing market adds another layer of stress. Mortgage payments have soared following the Bank of England's rate hikes, and renters face record-breaking lease renewals across major cities. The Resolution Foundation reports that middle-income households are now spending a greater share of their earnings on housing than at any point since the 1982. This leaves little room for savings or emergencies, pushing even financially stable families toward instability. Energy costs, though slightly reduced from their peak, remain a burden, particularly during colder months. The rise in council taxes and transport fares further squeezes budgets, leaving many with no safety net. As the gap widens between expenses and income, the potential for a consumer debt crisis grows increasingly real. Analysts from The Guardian and The Economist warn that a population living paycheck to paycheck weakens the foundation of national resilience. When households cannot absorb financial shocks, even small disruptions like a sudden utility spike or medical expense can ripple through the economy. Consumer confidence falls, retail sales decline, and loan defaults rise, threatening the stability of banks and lenders. The erosion of financial buffers across households doesn't just reflect hardship, it reveals an economy that has lost its capacity to protect its citizens from volatility. By 2026, this pressure could become a tipping point, turning private strain into a broader economic breakdown. Number 6. External pressures. The United Kingdom remains deeply exposed to external economic forces, and this vulnerability is becoming more pronounced as global instability intensifies. The country's persistent trade deficit, where imports consistently exceed exports, continues to drain national wealth and weaken the pound. Since Brexit, exporters have struggled with increased paperwork, customs delays, and regulatory divergence from the European Union, once its largest trading partner. Meanwhile, import dependency for essentials like food, energy, and manufactured goods has made the UK particularly sensitive to fluctuations in global prices. Each geopolitical flare-up or shipping disruption directly impacts domestic inflation and business costs, creating volatility that policymakers can only partially control. This structural imbalance makes it difficult to achieve stable growth or sustain investor confidence. The current account deficit, a measure of how much more a country spends abroad than it earns, has widened again in 2025, according to the latest data from the Office for National Statistics. Financing this gap requires constant foreign investment, but international confidence in the UK has weakened due to erratic policy signals and market turbulence. The depreciation of the pound, while beneficial for some exporters, raises import costs and reduces household purchasing power. At the same time, global economic shifts, such as slowing growth in China and trade fragmentation in Europe, further limit opportunities for recovery. Energy insecurity, compounded by dependence on imported gas, adds a strategic layer of risk. Even temporary supply disruptions can trigger significant inflationary spikes. Experts from Bloomberg and the Financial Times argue that the UK's external fragility could act as a catalyst for broader economic stress by 2026. When global investors perceive higher risk, they demand greater returns, driving up yields and pressuring the Bank of England to maintain restrictive monetary policies. A weakening currency may also deter international businesses from locating in the UK, deepening the investment gap. These external vulnerabilities do not act alone. They interact with domestic weaknesses, amplifying each shock's effect. Without a coherent trade strategy or structural rebalancing towards sustainable exports, the UK risks entering a phase where global turbulence consistently translates into domestic instability. Number 7. Energy, infrastructure, and green transition risks. The United Kingdom's energy and infrastructure systems are approaching a breaking point, caught between aging assets, underinvestment, and ambitious climate commitments. Decades of deferred maintenance have left railways, roads, and power grids struggling to meet rising demand. Frequent disruptions, blackouts, and transportation delays now cost businesses billions annually. At the same time, the transition toward renewable energy, while necessary, has exposed serious planning and funding gaps. Many offshore wind and nuclear projects have faced cost overruns or cancellations due to inflation and material shortages. As a result, the UK's energy security has weakened, forcing greater reliance on imported gas and electricity, leaving households vulnerable to global price shocks that can reignite inflation. The green transition, meant to drive new growth and sustainability, is faltering under political and financial strain. Several major energy firms have delayed or scaled back net zero investments, citing uncertain government incentives and volatile market conditions. The delay in modernizing the grid also limits the ability to integrate renewable sources effectively. As energy demand increases, the system remains dangerously unbalanced, risking supply shortages during peak seasons. These problems have cascading effects on industries like manufacturing, transport, and technology that depend on stable power. Every disruption reduces confidence in Britain's capacity to deliver on its economic and environmental promises. Without a reliable infrastructure backbone, productivity gains and industrial expansion become nearly impossible. Analysts from The Economist and the Energy Institute warn that energy insecurity and infrastructure decay could become a defining weakness by 2026. Businesses facing unpredictable costs are reconsidering operations in the UK, while households struggle with fluctuating utility bills that erode disposable income. The inability to coordinate a clear long-term energy policy undermines both investor confidence and national resilience. If these challenges persist, the country risks not only failing its climate targets, but also undermining its economic foundation. A modern economy cannot thrive on outdated systems, and the cracks forming beneath the UK's energy and infrastructure networks may soon determine its overall stability in the years ahead. Number 8. Industrial decline and strategic sectors under stress. The decline of the United Kingdom's industrial base has become one of the most pressing structural weaknesses in its economy. Once known as a powerhouse of manufacturing and engineering, the country has watched vital industries such as steel, automotive, and shipbuilding shrink or relocate abroad. This erosion of industrial capacity has left the UK increasingly dependent on imports for essential goods and technologies. Recent reports from the Department for Business and Trade show that output in manufacturing has fallen steadily since 2023, while industrial investment has stagnated. The closure of plants in Wales and northern England reflects not only the loss of thousands of jobs, but also the disappearance of high-skill employment that once anchored entire communities. The result is a two-tier economy, where service sectors thrive in London and the South, while traditional manufacturing regions face deepening decline. The government's attempts to revive industry through subsidies and levelling up projects have so far produced limited impact. Steel and automotive firms continue to struggle with rising energy costs, trade barriers, and environmental compliance expenses. Green technology initiatives, such as electric vehicle battery production, have suffered setbacks due to funding shortages and slow infrastructure rollout. These delays risk leaving the UK behind, as competitors in Europe and Asia accelerate their transitions toward advanced, low-emission manufacturing. When strategic sectors weaken, the nation loses not only jobs but also its capacity for innovation and self-sufficiency. This imbalance erodes export potential, increases trade deficits, and widens regional inequalities, all of which feed into broader social and political instability. Analysts from the Financial Times and Reuters warn that industrial decline threatens the UK's long-term resilience more than any short-term crisis. Without strong domestic production, the economy becomes dangerously exposed to supply chain disruptions and foreign market volatility. Reindustrialization requires stable policy, skilled labor, and consistent investment, three factors currently in short supply. As 2026 approaches, the risk is that Britain's industrial heartlands will continue to hollow out, undermining national identity and economic independence. When a nation can no longer produce what it needs, its vulnerability extends beyond economics. It becomes systemic, shaping the fate of its entire society. Number 9. Political instability and governance erosion. The United Kingdom's political landscape has grown increasingly fragmented, undermining confidence in its ability to manage crises or deliver long-term reforms. Frequent changes in leadership, divided parties, and eroding public faith in institutions have created a climate of uncertainty that directly affects the economy. Policy reversals, especially on taxation, immigration, and climate commitments, have left both domestic and international investors unsure of the government's direction. Recent polling from Ipsos and YouGov indicates that public satisfaction with political leadership is at a historic low, while voter volatility continues to rise. This instability weakens the government's authority to implement tough but necessary measures, leaving crucial reforms in limbo and governance increasingly reactive rather than strategic. Regional divisions amplify this instability. Scotland's renewed calls for independence, tensions over Northern Ireland's post-Brexit arrangements, and growing discontent in economically neglected regions all challenge the integrity of the Union itself. The perception that Westminster prioritizes London over the rest of the country fuels resentment and populism, pushing politics toward polarization. Meanwhile, austerity measures and public service strain add to civil frustration, with strikes, protests, and social unrest becoming more frequent. When political institutions appear incapable of addressing citizens' concerns, democratic fatigue sets in, allowing extreme narratives to gain traction. The longer this erosion of trust persists, the harder it becomes to rebuild unity and accountability across the political spectrum. Experts from The Guardian and The Economist warn that sustained political volatility is more than a democratic inconvenience, it translates into economic paralysis. Businesses delay investment decisions. International allies question the UK's reliability, and markets react nervously to inconsistent governance. A nation divided by ideology and geography struggles to plan for the future. As 2026 approaches, the risk lies not in a single political crisis, but in the cumulative weight of indecision and distrust. Without cohesive leadership and a shared national vision, the UK may find itself unable to respond effectively to mounting social, fiscal, and global challenges. Political instability thus stands as a silent accelerant to economic and institutional decline. Number 10. Financial and market stress. The United Kingdom's financial system is showing growing signs of strain, with bond markets and banks facing mounting pressure from high interest rates, sluggish growth, and weak investor confidence. Government borrowing costs have climbed sharply as gilt yields continue to rise, reflecting global concerns over the sustainability of British debt. Major fund managers have urged the Bank of England to halt its asset sales, warning that continued tightening could destabilize debt markets. As yields rise, the cost of servicing national debt escalates, feeding back into fiscal stress. At the same time, commercial banks face a delicate balance, earning more on lending while struggling with higher default risks from households and businesses squeezed by the cost of living crisis. This tension creates the conditions for a potential liquidity crunch if credit quality deteriorates further. The London financial sector, once a symbol of global stability, is also navigating shifting conditions. Post-Brexit regulations, shrinking foreign investment, and competition from financial hubs like Frankfurt and Amsterdam have eroded its dominance. Confidence in the pound remains fragile, with volatility increasing whenever political uncertainty or weak data emerges. Investors now view UK assets as riskier, demanding higher premiums to lend or invest. Even pension funds and insurance firms, traditionally stable anchors of the domestic market, are exposed to volatility in long-term bonds. The Bank of England faces limited tools, easing policy risks, reigniting inflation, while continued restraint could trigger credit tightening. The result is a precarious financial equilibrium vulnerable to external shocks. Analysts from Bloomberg and the Financial Times caution that financial instability may be the catalyst for broader economic collapse by 2026. Markets can absorb weakness for years, but confidence can vanish in days when sentiment shifts. If bond markets lose faith in fiscal discipline or banks face rising defaults, the UK could experience a rapid tightening of credit conditions reminiscent of past crises. The financial sector's fragility, intertwined with public debt and household stress, represents the final link in a chain of systemic vulnerabilities. The signs of decline across the United Kingdom are no longer isolated warnings. They form a pattern that points toward a deeper national reckoning. An overstretched economy, political fatigue, and social strain are converging into a moment of profound uncertainty. Each sector, from finance to industry, reveals cracks that can no longer be dismissed as temporary setbacks. Yet collapse, if it comes, will not arrive in a single dramatic instant. It will unfold quietly through shrinking paychecks, vanishing investments, and the steady erosion of public confidence. What makes 2026 pivotal is not just the weight of these problems, but the growing sense that solutions are slipping out of reach. Still, crisis brings clarity. The country stands at a crossroads where honest leadership, structural reform, and renewed investment could either rebuild resilience or allow further decline. Britain's fate will depend on how quickly it confronts uncomfortable truths about its economy, governance, and global role. If action falters, the coming years could mark not merely a downturn, but a transformation few are ready for. If you found this analysis eye-opening, make sure to subscribe for more in-depth explorations of global and national turning points. Share your thoughts in the comments. Do you believe the UK can still recover, or has the decline already begun? Your perspective matters, and your engagement helps keep critical conversations alive. Stay informed, stay aware, and join us next time as we uncover the forces shaping the world ahead.